Welcome to APA's weekly webinar series. My name is Billy Zadig, Standards and Codes Administrator for APA. Just a couple of housekeeping items before we get started. The webinar recording will be posted to the APA webpage later this afternoon. You will receive a follow-up email tomorrow with a link to the webpage where all webinar recordings are housed, as well as a link to our upcoming webinars. We have webinars planned out through April of 2020 and are now open for registration. All attendees are in listen-only mode. Please type your questions in the chat box and they will be answered in the order they are received during our Q&A session at the end of the presentations. If we run out of time and we still have questions, responses will be sent directly to the person asking the question by our presenter. Professional continuing education credits are being offered. Please send me an email at billie, B-I-L-L-I-E, @apa.org to request a certificate if you did not indicate you wanted one when you registered. Also, if you have more than one person attending this session from a central location, please contact me so everyone gets credit for attending. At this time, it's my pleasure to turn this over to Chris Kopak, who will be your moderator for today's webinar. Chris, take it away.
Thank you, Billy. We appreciate that. Hello, APA. Chris Kopak, System Vice President, Facilities Management, past President of APA. As we continue our webinar series, Continuous Learning, we sure appreciate Kinetic Energy Group and Andy Hunfield, Director of Energy Price Risk. This is about the time that we start looking at the winter weather coming in, cooler months coming, and we start looking at our gas purchases. And what appropriate time, Halloween, that Andy will be talking about 3 things that could scare energy prices higher this winter. So Andy, I see you have some Walking Dead photos on your screen here. Go ahead and take us away. And as Billy mentioned, if you have questions, please send them to us. We also will be putting questions in throughout the hour presentation. Thanks again, Andy. We appreciate it.
Thanks, Chris and Billy, and thanks everybody for joining. And like Chris said, being that it is Halloween, we wanted to talk about, obviously the weather is always a big factor during the winter, but I'm going to kind of get into detail about 3 other things besides the weather that have us scared a little bit, and maybe should have end users scared that prices aren't going to stay low throughout the winter season. So we'll kick it off here. We'll start off with a general overview of the natural gas market. I know we've got a wide range of folks on the call, some that follow energy markets and some that don't. And just to be clear, I'm going to be focusing on natural gas throughout the presentation. Just know that natural gas is the #1 driver of power pricing as well in the vast majority of the country. There are other variables there that affect electricity, but if we're talking about higher natural gas prices, there's a very, very good chance that your electricity prices will go up as well. So I'm using gas as a proxy, but we're talking about both types of energy throughout the presentation. So we'll look at some of those fundamentals and just an overview of how that market works, just as a refresher for those that aren't in this all the time, and introduction to those that are brand new to talking about energy markets. And then, the title of the presentation is 3 things besides the weather, but we can't talk about winter energy prices without at least dipping into some initial forecasts. So we will look at a couple of those, and then we'll get into these 3 other factors. And of course, those are slow zombies, fast zombies, and ghosts. And to correlate those to the gas market, slow zombies, I'm looking at that like generation demand, LNG exports, and then speculative trading. And we'll get into some of those analogies as we move through the presentation. So to start off really quick, just an overview of what our market in the United States looks like. The vast majority, and actually a still growing percentage, of all of our supply is produced here domestically. There was a point 15 years ago when conventional wisdom was that the U.S. is running out of domestic natural gas supplies, and we are going to be turning more to imports in order to meet growing domestic demand. What we've seen is quite the opposite. With the proliferation of hydraulic fracturing and horizontal drilling, we've seen production grow to one-time unfathomable levels, and that's really worked the need for imports out of the marketplace. We do still import a little bit of gas from Canada, but that percentage is shrinking almost on an annual basis. So the vast majority of our supply does come from right here in the United States. The demand side of the balance sheet, though, is a lot more segmented. It divided in about thirds between power generators, which is the fastest growing demand sector over the past decade. We combine residential and commercial demand just because that is primarily going to be driven by heating load and primarily going to come into play during the winter months. And then industrial demand is the other major domestic sector. That is natural gas that's used for process load across the country in industrial facilities and also for heating load in those same facilities. So there's a bit of seasonality to that as well. And then the next sector is exports, and that is growing very quickly, making up on an annual basis a much larger piece of this overall pie. Right now, we're a net exporter of natural gas via pipeline into Mexico, and we are seeing a lot of new capacity to liquefy natural gas, which means you cool it down to about negative 240 degrees. It kind of reverts to a liquid state. You can load it on a tanker and send it all over the world. And we'll talk in depth about what's happening there and some of the prospects for growth even here in the near term. So this is how the market shakes out. When you look at this on an annual basis, and I'm just using 2017 here as an example, supply is generally flat throughout the year. It's either going to be growing or falling or fluctuating a little bit month to month. There's a bit of seasonality there, but not much. Meanwhile, demand is very seasonal. So during the winter months, when that residential and commercial load really picks up, when folks are heating spaces, we use a lot more natural gas than we're producing on a daily basis. So the solution that we have in the United States is we have the largest network of underground natural gas storage in the world. So during the summer months, April through November, when on a daily basis, typically supply is larger than demand, we've got all this excess natural gas on the system that's picked up by storage operators to inject underground and hold until the winter. In about 2 weeks, we're going to see this scale tip, where on a daily basis, we're going to need more gas for heating purposes than we're producing on a daily basis. So that gap is made up for by taking natural gas out of underground storage. So these storage levels are a big deal for the marketplace. At any given point, we're watching how close is storage to where it was a year ago, how close is storage to the 5-year average for this same week, how fast is it growing, because that gives us a lot of information about what the supply and demand balance looks like. So generally, if storage is growing faster than it was last year, that means that growth in supply over the past 12 months has outpaced growth in demand. And that's exactly what we've seen for most of 2019. We started off with a pretty low storage level back in March, but we've built up our inventories at a record pace. And a lot of that is due to the fact that we're producing more natural gas than ever this year. We're seeing right now about 92 billion cubic feet of production every day. And that compares to last year, we produced on average about 85 or 84 BCF per day for the whole year. So we are growing that production very rapidly so far. We have some concerns about that going forward, which we'll get into, but a big reason why prices are so low this year is because it's been a very oversupplied market. However, even with that oversupplied market, storage inventories are still at about average levels. We just barely crossed over the 5-year average over the past couple of weeks, and we are not going to be even as high as we've been at times during the past 5 years going into the winter. And that opens up the door for risk. So when we talk about these other supply and demand dynamics across the fundamental balance, look at that in the context that we don't have as much storage as we possibly could in underground inventories. And if these get drawn down quickly and get drawn down to closer to the bottom of the 5-year range, typically that's going to lead prices to rise. So that's just kind of a general statement, but usually that's how the market behaves. If storage is pulling down faster than usual or faster than last year, then that puts upward pressure on natural gas and energy prices across the board. So prices, and I just wanted to show this. We're going to revisit it near the end of the deck. But right now, when we look at future pricing and forward pricing, a long way out into the next decade, really through 2023 and beyond, we've got prices at historic lows. If you look out over the past 12 years plus, the past 20 years really, you don't have many, if any, examples of prices settling out for an annual strip lower than what's being currently offered across the board. 2016 was about as good as it gets for end users. We didn't have a winter that year. 15-16 was very much a non-existent winter season. It was one of the warmest in the past 50 years. So we had storage inventories on this slide. That was when they were up at the top of that 5-year range. And we had a major price collapse at the beginning of that year that very quickly kind of recovered because of a number of different factors. But 2016, that's as good as we've seen it over the past couple of decades. And right now, if you go out into 2020, 21, 22, you can buy gas at about the same price you would have paid at the market at 2016. So generally, we see very little downside in these longer term forward prices. And we'll get into some of the reasons why as we move through the deck. So shifting gears a little bit, right now we're in the midst of what's looking like a very strong start to the winter season. And this changed to some degree just over this past weekend. These are forecast maps as of this morning from one of our trusted outlets here at Connect. And anything blue or especially purple is cooler than normal is how to read these maps. And what we're looking at is the 6 to 10 day and 11 to 15 day. So this takes us out through mid-November, and then the last map is November as a whole. And it doesn't take a meteorologist to see that a lot of parts of the country that are very densely populated, the upper Midwest, the Mid-Atlantic, up and down the East Coast, that typically rely on natural gas for space heating purposes, are poised to be very much so below normal for the next couple of weeks. So this is looking like a very kind of fast start to consumption this winter season. This has already had somewhat of an impact on market pricing, but if these colder forecasts continue, along with the other factors that we're going to be talking about during the presentation, this will certainly almost be an exacerbating factor and lead to even more upside to be realized. The next slide just shows a couple of examples of December through February outlooks. We saw another one of these come out yesterday that shows a very cold bias for this time frame. But the theme is, and these seasonal forecasts historically are going to be very inaccurate, but this does give a hint of what the market's looking at least. Right now, the consensus is for an enhanced cold risk in the upper Midwest and potentially the Northeast. So again, that's an area of the country where a lot of folks live and a lot of folks use natural gas to stay comfortable during the winter. So that's kind of a recipe for a season of very elevated residential and commercial consumption, which plays in with the rest of what we're going to be talking about. Could end up drawing inventories down very quickly and lead to some upside price risk to be realized. So with the intro and the weather forecast out of the way, we'll kind of get into the meat of the presentation here. And we'll start off with the slow zombies, and that's generation demand. If anybody has watched The Walking Dead, these are zombies that are very methodical, very plodding. They're steady, though they're coming at you, but they're not going to be sprinting at you or anything. You just kind of have to outsmart them. And that's very similar to what we've seen with natural gas fired generation over the past decade. We haven't seen giant leaps year over year. It has been more of a steady increase. And that's because we're talking about a massive shift in the structural generation mix in the United States, where across the country, especially in the mid-Atlantic and even more so along the West Coast, we're moving away from coal-fired generation. And we've got a large fleet of aging generation plants and no new investment in future coal generation plants. So these aging plants are coming offline either at the end of their life cycle or in a lot of cases a little prematurely because they're faced with economic challenges trying to compete with natural gas. They're faced with some regulatory challenges trying to keep up with emission standards. So regardless of the reason, coal is making its way out of the marketplace. And it's being replaced by renewables to some extent, but mostly by new natural gas demand. So that has resulted in a huge increase. We've gone from about 19 billion cubic feet per day 10 years ago to more than 30 billion cubic feet per day so far in 2019 through the first now 10 months of the year. So you do see some fluctuation. This is still weather dependent and it's price dependent. If gas prices are really high, then other forms of generation, even coal, can come back and compete. But if they're low, then gas is by far, like it has been in 2019, by far the cheapest form of generation outside of renewables from a certain perspective. And you see consumption increase. And in 2019, we are on pace to set a new record here. But the trend is clear. We're consuming more gas almost on an annual basis. And the further we get into the future and when we look out at plans for new gas-fired generation, plans for coal units to come offline, it raises the ceiling of how high this can get during the summer and during peak demand times, but more importantly, it raises the floor. So even during the shoulder season and even during times in the winter where maybe it's not as cold, you're still seeing a lot of consumption here for baseload purposes, just the amount of power that we need around the clock across the country. More and more of that is being produced by natural gas. And on the next slide, we can see those structural shifts. We're highlighting three distinct sectors here of the mix. And this is megawatt hours generated, not installed capacity. So coal, natural gas, and then what I'm calling non-hydro renewable, but really that's wind and solar. Virtually all of that is wind and solar. So since 10 years ago, we've seen natural gas go from 23% of the mix to 37% of the mix. Coal has gone from 44% to 24%, and that wind and solar has more than doubled, almost tripled, from 4% to 12%. So impressive growth there as well. But the takeaway here is that as we go forward, we're minimizing coal, we're maximizing natural gas, and that has some consequences for the gas market. It means that demand continues to rise, and even as quickly as production has grown over the past decade, this has been the main driver of demand virtually keeping pace with domestic production since 2009. There is another kind of longer term aspect here to consider, and that's in that gray area at the bottom of the chart, and that's the other that doesn't change much from year to year, but about 20% of the whole mix every year is from nuclear generation. And we haven't seen this really start to gain steam yet, but in the next 5 years, we're set to start to begin to see some of these major nuke plants come offline. There's one in New York, a couple in California, and as those come offline, that's baseload around-the-clock generation that we need to backfill. And in a lot of cases, wind and solar aren't up to the task until we really improve battery technology to be reliable around-the-clock forms of generation. So that's going to continue to favor natural gas and could even accelerate the increase in natural gas's share of this generation mix. So this it increases demand for gas, obviously, but two, it further ties electricity prices to natural gas prices across the country in most markets. So the more of this mix that is relying on natural gas, the more closely those energy markets are going to be intertwined, and we're already very intertwined from this perspective. So now we're going to spend some time talking about fast zombies, and that's exports. If you've ever seen the movies 28 Days Later, 28 Weeks Later, these zombies have a little bit different demeanor than what you see in The Walking Dead. They're not slow and plodding. These things will chase you down. And this is the type of growth that we've seen in exports just over the past 3 years, and we expect to see even more rapid growth, at least through the first half of 2020. So this is what, in my view, the biggest contributor to structural risk in the market this winter. And we'll talk about how this dovetails a little bit with the generation piece to really change the fundamental balance over the course of the next season. But exports are a big deal, and they're becoming a bigger deal very quickly. If you go back 10 or 11 years ago, the U.S. was still a major net importer of gas. We brought in 2008, when you look at liquefied natural gas, imports from Canada, minus exports to Mexico, our net exports were around 8 BCF per day. In 2018 or in 2017, we first became a net exporter overall of natural gas. We saw that accelerate in 18. We're seeing that accelerate even more in 2019. So this is a big deal. It's a game changer for the U.S. market. Not only is this introducing new demand, because these liquefied natural gas terminals, as we'll talk about, are consuming gas not unlike the generation sector on an around-the-clock, weather-independent basis. But this also is going to gradually, as time goes on, tie the U.S. more to the international marketplace. So think about crude oil and the price of gasoline that you pay at the pump. If something happens, if there's a drone strike in Saudi Arabia, that is going to impact the price that you pay in the U.S. Even though the gas that you're buying was refined and likely around the Gulf Coast, probably from crude oil that was produced in West Texas, we're still in a global market when it comes to crude oil. So if prices go up internationally, they're probably going to go up domestically. The natural gas market for a long time has been a much different story. We've been very domestically contained with very limited export capacity, and the import capacity is limited to mostly North America. So the best example of this, or the worst example, was in 2011 when we had the tsunami and the Fukushima disaster in Japan. We saw Asian gas prices spike up to over $20 per MMBTU for a long period of time. In 2011, we're very isolated from that. But as we continue to add more liquefied natural gas capacity and become more fundamentally connected to the global marketplace, it increases the number of international risk factors that actually could impact the price you're paying at the burner tip at your school for natural gas. So this is not only a near-term risk, as we'll talk about moving through the winter, but very much a long-term game changer that is going to fundamentally shift the way that the markets treat natural gas in the United States. At the moment, when we look out at forward pricing, this isn't, in my opinion at least, necessarily being fully priced in. That added risk is not being considered by the long-term market, and that is, as we'll talk about further, does open up the opportunity for long-term, very advantageous purchasing, in my opinion. So this next graph shows how quickly this has changed. And these are there's 5 major LNG export facilities that are currently operational in the U.S. 2 of these just came online within the past 3 or 4 months, and then one very small facility in Savannah, Georgia called Elba Island. It's not going to move the needle much. But we do see additional capacity coming online at the Cameron and the Freeport facilities, which are both located along the Gulf Coast. We have recently seen liquefied natural gas export demand cross 7 billion cubic feet per day. Last year at this point, it was about 3 billion cubic feet per day. So that's doubled. And we expect to see that grow even more between now and the middle of 2020, with a lot of that growth scheduled during the winter season. So this is, again, structural demand that's not weather dependent, and a lot of times not even price dependent, because of the way that these deals are structured, where it's more or less kind of a take or pay with the counterparty. And so far it's been in, the counterparties have been taking delivery of this natural gas. And as this has come online, it's been more or less, outside of periods of maintenance, fully utilized, and we expect that to continue. So this is has been a game changer for the marketplace. It's working to offset some of the increase in supply, but we expect those scales to maybe tip in the other direction as we get into the winter season and this demand is online. Beyond this, there's more uncertainty. So these are the first to market facilities. There's 5 or 6 other facilities that have full government approval. They could start construction tomorrow if they would like, but they're having a little bit more trouble getting those same take or pay deals that this first wave was privy to. So the final investment decision is a little tougher. Global pricing's come down some. It doesn't look quite like the slam dunk arbitrage opportunity that these facilities had 5 years ago when they started construction. But we still do see another wave materializing in the middle of next decade. So we might see this plateau to some degree from around 2020 to maybe even 23 or 24, but then we do expect to see another major increase in liquefied natural gas export capacity in the middle of the next decade. So this next slide is a little bit of a deviation, but with the trade war that we're in with China right now, that obviously gets a lot of headlines. I get this question a lot. What happens if China stops importing U.S. sourced liquefied natural gas? Won't that strand a bunch of gas here in the United States and make prices go down? And the answer is China has already essentially stopped importing U.S. sourced liquefied natural gas. They've imported just 4/100ths of 1 billion cubic feet per day on average for the year, and most of that was back during the first quarter. We have a wide range of trading partners here. We've exported to 31 unique nations so far in 2019, with South Korea, Mexico, and Japan being the largest destinations for our LNG export cargoes. So the answer is, if China doesn't want the gas that's sourced in the U.S., somebody else does. And we've seen that play out in a big way so far in 2019, where the industry has had no problem continuing to grow and continuing to send out more volumes, even with that major market off the table. That market is important for that next wave of projects, though. So assuming that we do see some sort of a resolution in the trade dispute, we would expect to see maybe some of our LNG export terminals, the future export terminals, looking to deal with China and looking for that as a destination for future cargoes. But for now, this has had a very little impact fundamentally on our gas market here in the United States.
Andy, on the slide here, what would the impact of, if they're able to solve the Brexit question, would that increase any of the gas purchases or exports to the UK area?
Chris, I'm not sure about that. I haven't really dug into those details. We do export to the UK. They're a importer of LNG from a number of different sources. So I know that right now the trade deals that we've got with the EU are a little bit different than they are with the UK. I don't see any immediate impact there, but that's something I could dig into. Right now, I don't have anything off the top of my head.
Okay, thank you.
Yep. So get back to our zombie analogy here. There's always the heroes, right? There's always something that's fighting back the evil, and this is our Walking Dead crew, most of whom, if you watch the show, which I stopped a few years ago, I think are no longer on the show. But so far, the hero has been domestic production. We are increasing almost on a monthly basis still. That rate of growth is slowing a little bit, as we'll talk about, but we've been swimming in new natural gas supply in 2019. So even though we're seeing increased exports and increased generation load, so far the market's handled that very well. We can see on this next slide the trajectory of production growth. We had a break in 2016, and that's important. That was when prices got too low and production wasn't economical, and we saw a lot of these companies producing natural gas in a lot of financial trouble. So we actually saw a 2-year downturn in domestic production. We could see that again in 2020. That's not the purpose of this presentation, but we've seen evidence that producers are not happy with prices. They're not doing so well financially anymore, so they may be curtailing some of those growth resources, and they have been already. So we could potentially see a downturn again next year, just as an aside. But the takeaway here is that so far in 19, this rapid growth, where we've seen volumes recently surpass 90 billion cubic feet per day, that has helped keep the prices at historic lows, and is a reason why we saw 20-plus year pricing, 20-plus year low pricing during the summer, and why the forward curve is still so depressed. But here's where the concern comes in. We tend to look at the market on a year-over-year basis. Are we better supplied than this time last year or worse? What direction are we moving in? And last October, we were producing almost 12 BCF per day more than we produced in October of 2017. While we're still growing, that rate of growth has slowed. So this October, we're producing about 5 billion cubic feet per day more than we did last year. We were still growing volumes very rapidly during the fourth quarter of last year, maybe not as much on a year-over-year basis, but we did see some big gains at the end of 2018 that we might not expect to see here in the near term. So this rate of growth is very likely to slow even more as we get into the winter. And right now we're estimating, whereas last winter, November through March, the U.S. produced about 87 billion cubic feet per day of gas. This winter, we're forecasting around 91 billion cubic feet per day of domestic production. You do see some freeze-offs and things like that during the peak of winter, so that stunts some of the recent growth that we've seen. But we expect overall to see about a 4 billion cubic feet per day cushion in supply. So in a vacuum, if nothing else changed since last year, we'd have 4 billion cubic feet per day throughout the entire winter that we didn't have available last year. And that takes some pressure off of storage inventories, because it means that we have to dip into underground stocks at a lower rate because we've got this excess production that's out on the system every day. However, what have we been talking about? We're talking about an increase in generation demand from a structural standpoint of about 0.5 billion cubic feet per day, and increases in exports when you combine liquefied natural gas and send out to Mexico of about 4 billion cubic feet per day, and that might even be a conservative estimate. So in all actuality, the market, even though we're producing so much more gas, will actually be tighter than it was last year on a weather normalized basis. If you do see a very cold season play out, then it exacerbates this. So these zombies, for lack of a better term, are working together. It's that combination of structural demand increases on the generation side and rapidly rising exports that are going to eat through that oversupply throughout the winter season and into 2020, which means that any increase in weather-related demand will likely have an exaggerated impact on both storage and subsequently price throughout the winter season. So this is a big issue this winter. The market, I think, has largely ignored it like it tends to do coming into the season. But the price action, if anybody watches the market, and we'll look at this in a few slides, the past couple of days is maybe starting to build in some of this risk that we see as very apparent in the upcoming months. So the last factor here, that's kind of an external factor that's a little bit scary to us, and we're seeing this maybe play out in the past couple of days, is speculative trading. Speculators are scary to especially end users. A lot of times they maybe get unfairly demonized, like Slimer here from Ghostbusters. I think he was misunderstood for a while, but he's actually kind of a friendly ghost. Speculators do perform a very important function in the marketplace. They provide liquidity, they provide price discovery in a lot of cases, and they provide counterparties to deals with end users that otherwise might not be able to find anybody to trade with. But at times, ghosts can be scary, and speculators can exacerbate swings in the marketplace. And just about a year ago, we saw a move, and there were other factors that were playing into this. But we saw natural gas prices, benchmark prices, go from below $3 to almost $5 over the course of about 4 to 6 weeks. And a lot of that was driven by speculative trading. So there is something brewing out there right now that has us very concerned that we could see maybe not that big of an increase in prices, but we could see a very significant rally as we move to the winter, and we'll talk about that. So first, quick intro just kind of on market mechanics. And this is not only true for natural gas, but essentially any commodities market, any futures market. It's a zero-sum game. So for every long position, there is a short position at that same price. So every buyer has a seller. which means that when you look at open interest in the marketplace, which is how many contracts are outstanding, all of those have an equal long and short side. So if I go buy today, that means that there's a counterparty out there that's selling me that contract. The participants in the marketplace vary dramatically in what purpose they serve and why they're in the market to begin with. And generally, this is made up of gas producers, gas suppliers, end users like everybody on the call, swap dealers that are out there making markets and using futures to offset and hedge against their positions, and then finally the big bad speculators. And like I said before, while these speculators may be scary, they do provide a very important function in the marketplace because they're actively trading and they provide a lot of the liquidity that's necessary in a functioning futures market. So we watched something called the Commitment of Traders Report. And the Commitment of Traders Report comes out from the CFTC, the Commodities Futures Trading Commission, and it gives you a snapshot of where all of these different entities are positioned in the marketplace. So we're dividing this between commercial traders, which are essentially hedgers. They're out there either offsetting their cost or hedging their production forward in the case of producers and suppliers, where they're making sure that they are going to get the price that they need out into the future. And then the non-commercial traders, which are generally going to be speculators, that's called managed money, and a lot of times that represents hedge funds. So those hedgers, they're offsetting basically the cost of doing business. They're not in the business of trading gas to make a profit. They're in the business of managing risk and establishing price certainty, like everybody on the call today. Meanwhile, these speculators, they are attempting to make a profit. They're trying to predict moves in the marketplace and profit off of those moves. So both of these are happening every day. Both of them carry a lot of importance for a functioning market. At the moment, speculators, according to this data, and this goes through last Tuesday is the most recent update we have, they've got a very large net short position, which means that the majority right now of hedge funds are betting that gas prices are going to go even lower. Are they right? Maybe they are, and maybe these positions continue to be profitable. But more than likely what happens, and what we've seen in the past, and the gray line on this is showing the net position of this managed money, of the non-commercial traders. And right now they're net about 200,000 contracts short, which is almost a record. We saw that record set back earlier this year. There was a wave of short covering, which means entering buy orders into the marketplace in order to offset those positions. If they're profitable positions, if they sold up at $3 and bought it back at $2.80, that's a very profitable trade. So typically when you see this get to an extreme, one way or the other, whether it's a very net long speculative position like we had a year ago when prices were up over almost at $5 for a little bit, or a very short position like we have right now, typically that's a good indication that things are getting ready to turn in the other direction. And what makes them turn in the other direction is that some sort of a catalyst, whether it is something on this chart, which is the prompt month continuation chart for NYMEX natural gas, or a very cold forecast here early in the winter season, it causes these traders to start covering quickly their positions. That overwhelms the overall marketplace with buying interest, and in turn prices start going up. We saw a preview of what this could look like back in September. If you look on this chart, we had that record short position start to cover and then start adding short trades again. And that's what's led to this volatility, where we had a price spike from late August to mid-September, followed by a collapse. And right now we're in the midst of another spike. Given the time that we are in the season, where you can bet that, especially with the cold forecast, with the structural changes in the generation mix, with the new exports, that these speculators that are trying to make a profit are not going to want to be short natural gas going into what's starting to look like a very risky winter season. So this short position will potentially gradually, if it gradually covers, it's not as big of a deal. But what we're afraid of is that it starts to cover in mass, and we start to see all of these traders trying to exit quickly, and that's what can lead to violent rallies like we've seen over the past 3 days, where November gas went from 230 to about 260 at settlement, and then December continued higher yesterday. We're seeing a little bit of a break today, but we feel like we could be at the beginnings and in the midst of what might be a broader seasonal rally that puts our pricing back probably where it belongs for the winter, up above $3 per MMBTU. So I know that gets a little bit into the weeds here, but that's something that we're watching very closely right now. Like our analogy, like ghosts, a little bit more difficult to understand. You don't know quite what they are, but this is certainly an external factor that can it can be an exaggerator of price movement, and we've seen that play out just in recent months. And that could continue to play out as we get closer to the winter season. And one of the reasons why we think that there's more upside to be realized in this marketplace. Meanwhile, so the good news for end users is that the price movement that we've seen so far has been very much focused on the upcoming winter. And assuming that you have a dynamic hedging program in place and you're managing this cost, it's very likely that you've already locked up the winter commitments and you're isolated from this risk. At least I hope you are. If not, you know, there's still potentially some time here. But the good news is the longer term deliveries are still pretty low. We've seen maybe a 25-cent rally in the balance of winter. If you go out to 2021, it's up by maybe 3 cents. So we haven't seen a big increase deep across the forward curve. And this is still very much a market that is very advantageous for long-term planning. So to wrap up with the maybe now tired Halloween analogies, it helps to have a plan. And we recommend all of our clients and anybody that's not a client to look at your future budget, look at how much energy you're using, and develop a custom risk management plan to take advantage when the market gives opportunities like it's giving now, but more importantly, to isolate yourselves from the risk that keeps coming back into the marketplace. Even with record supply, this is still a market that is rife with risk, as we've talked about, and we need to be positioned against that because we're not in the business of speculating natural gas. Having a totally open position when you're a large end user is very much speculation because you're up to the whims of the market on a month-to-month basis. It helps for long-term budgeting, long-term capital planning to at least gradually lock these prices in, establish price certainty, and isolate yourself from the spikes that are very possible, especially during these winter months. So in summary, prices have been extremely low for most of 19, with 20-year lows over the summer, and most of that is due to the fact that we're producing more natural gas than ever. Winter forecasts are starting to look cold. So weather is very difficult, if not impossible, to predict, but at least at the moment, the near term's looking cold, and more of the seasonal forecasts are looking like a below normal type of a bias in key parts of the United States. At that same time, we're seeing the fundamental balance tighten for reasons that we've already discussed, which could certainly exacerbate price risk over the coming season. So to reiterate, universities and all institutional users of natural gas and electricity should be taking action, exploring long-term purchasing strategies, and taking advantage of what the market is giving us right now. And that's all I've got as far as slides go, but happy to entertain any questions, Chris, or anybody from the group.
Yeah, perfect, Andy. And maybe what you can do is put that Ghostbuster slide back up. That was always a great movie there, for those who remember it. You know, the questions right now, feel free to go ahead and type them in, send them. And Billy, I don't see any questions yet on the screen unless I'm missing something. But I have a couple questions that I just want you to go ahead and give us more details on. You talked about nuclear plants. Do you have any idea on the total number of nuclear plants that we have throughout the United States? And then you talked about some that will be coming offline. What's the projections over the next 10 years of how many are coming offline?
So off the top of my head, I do not know exactly how many nuclear plants that we have specifically. We've got a large number of plants and reactors across the country. The ones that are along the coast are typically the ones that are going to be in danger of retiring and decommissioning. It's not like even a coal plant, which is a long decommissioning process. That's nothing compared to bringing a nuclear plant offline. There's a lot more to consider, obviously, with disposing of the fuel and safely bringing that plant down. Specifically, we're seeing one in New York. And the name of that escapes me, that's coming offline next year. And that's very much reflected in power prices in that specific market right now, with a lot more volatility beyond when that plant is expected to come offline. Indian Spring, I believe, is the name of that plant. And then California is in the process of totally phasing out nuclear power. And that state has 2 plants that are poised to come offline by 2025. So this isn't an immediate thing necessarily, but kind of like you alluded to, over the next 10 years, we could see, say, a quarter of nuclear plants realistically be retired. And that's 5% of the current generation mix, and maybe not as violent of a movement as we've seen in coal, but certainly generation capacity that needs to be made up for, and very likely that will be made up for in a lot of cases with gas-fired generation.
Excellent. Thank you, Andy. Andy, could you talk further about the wind and solar over the next year? One of your slides talked about the increase in gas, decrease in coal, and we've seen a uptick, a small percentage in wind and solar. What are the 10-year and possibly even 30-year federal forecasts looking like for wind and solar?
It's hard to say, actually, beyond the next few years, because, you know, with a lot of these capital projects, they're going to announce and start making plans to come onto the grid 3 to 5 years in advance. So that's kind of our window where we can look out with any degree of certainty and see what is being added. And we're seeing a large percentage of new projects are focused on wind and solar, even without any current prospects for a federal subsidy, for lack of a better term, or benefit there. So it does seem like those economics have shifted. And right now, wind and solar can be very competitive in a lot of parts of the country with fossil fuels, if not outright beat them. And, you know, the more that technology develops, and especially if we were able to get any sort of very reliable, large-scale battery technology off of the ground, then that would increase the baseload viability of those types of fuels. So we do have a strong positive outlook for those over at least the next decade. 30 years, you know, who knows what we're even going to be doing as far as generating power. We would assume that there'd be some sort of you know, maybe some major leaps in technology that's not even in our radar right now. So I hesitate always to project anything past the next 5, especially past the next 10 years, just because those outlooks are always so nebulous, and we truly don't know what the landscape is going to look like that far out into the future. But for now, we do expect to see continued increase in the percentage that wind and solar make up of this generation mix as these come online, and until they are more reliable around-the-clock sources of generation. A lot of times it's going to be natural gas that comes in to solve some of that intermittency. And we've seen that play out this year in Texas. West Texas has a lot of wind-fired generation. There's been times during the summer when that wind-fired generation wasn't available because the wind wasn't blowing, and we saw some real problems on the ERCOT grid where those prices spiked up to, in some cases, over $700 per megawatt hour. So there are still some challenges there, but I'm confident in the ingenuity of the United States, and I think that we'll overcome those challenges and long term see ongoing and even accelerating growth in that renewable space.
Thank you, Andy. We got the questions coming in now. Tom Kelly has asked a question regarding the hurricane season as we're coming on the tail end of it. Have you seen any impacts with the hurricanes? I know there was one that came through the East Coast several weeks ago. Impact on gas supplies, natural gas supplies?
So it's kind of a interesting development over the past 10 to 15 years in the marketplace. So if you look back, and the biggest example of this was in 2005, Katrina and Rita came through and just devastated the Gulf Coast and went right through the middle of gas and oil production, and took a lot of that offline for a long period of time. It took 6 months plus before we recovered from that, from a natural gas production perspective. But when that happened during that event, the U.S. got around 15% of its overall natural gas supply from the Gulf of Mexico, and even a lot more just from around the Gulf Coast. As production has moved inland up to the Marcellus Shale and even more recently further west into West Texas, that risk has been diminished to some degree. We still do get some supply from around the Gulf Coast, but instead of 15%, it's closer to 3% of our overall supply, or 4% of our overall supply. So we've actually seen that kind of flip upside down, where a hurricane hitting the Gulf of Mexico or even the East Coast is going to have a bigger effect on the demand side. So kind of counterintuitively, when that storm comes through and reduces temperatures, knocks power out, and potentially disrupts some of these liquefied natural gas deliveries, a hurricane, fundamentally, if you really look at it, is actually bearish for natural gas, because the demand destruction and the limiting of export potential is actually stronger than what you can see on the supply side. The caveat there is that if it is a devastating storm that knocks off 3 to 4% of our production for 6 months, that is still impactful. But the market has started to kind of discount hurricane risk. You don't see a big increase as the storm's approaching like you used to. And unless you see a truly devastating storm, it is actually more limiting of demand than it is restricting of supply.
Thank you. Mary Fisher has asked a question here, and it's regarding just there's so much information out there on natural gas purchases, a lot of detailed information that you've shared today, which is always really helpful. What are some additional information that our officers who are responsible for buying strips of gas, what are resources that they can reach out to stay updated on a weekly, monthly, quarterly, annual basis?
Well, without tooting our own horn too much, Connect Energy, we put out weekly publications, we do periodic webinars like this, and we do dedicated conference calls. I've worked with a lot of university clients that we have a detailed meeting every 3 months where we go through basically all of these different types of factors, look at opportunities and risks in the marketplace. And there are, other firms like us that can help manage that spend and keep everybody informed. From a publicly available perspective, the Energy Information Administration, which is a wing of the Department of Energy, is by far the best in the world as far as government data and energy transparency. I try to do some analysis on foreign countries, and even Canada and Mexico, the information is a lot less available. If you spend some time poking around on the EIA's website, you can find more information than you'll know what to do with. They do a really helpful, just daily kind of energy brief that talks about something going on in the marketplace, and they have a wealth of fundamental supply and demand data, pricing data, not only for natural gas, but crude oil, coal, electricity, you name it. So the EIA is the best by far kind of public and free information source for anything energy market related. And if you just kind of dig into that, you can learn a lot about these markets without paying anything. But selfishly, we like to do that for people. So, we know that that's maybe not your job to follow the natural gas market. It is our job. So that's part of our value proposition is, we follow markets for people and kind of make sure that they're informed as they need to be, but not caught up in all the weeds and the details.
And Andy, I know we don't use this as an opportunity to broadcast everything, but I will say as a testimonial, the newsletter that you all supply on a weekly basis, we end up getting it here at the University of Arizona every Monday morning. It's in my inbox. It's a really quick read, but a really useful information. And so if folks want that information, you can put a link to where they can get that. Is that correct?
Yes. The weekly report is for clients, but it's certainly something that we could have a conversation about.
And so Paul has a question here, and it's regarding, there's been talk, is there going to be a recession in the United States? Is there not going to be? We're coming into election year in 2020. Lots going on right now. If there is a mild recession in 2020, what would the impact be on the gas supplies?
So that's a multifaceted question for sure. But assuming that plays out to some degree, the biggest influence it would have would be on the industrial sector. And we didn't get into much of the details on industrial demand, but it does represent about 27% recently of the overall demand picture. When in 2009, industrial demand fell off dramatically and led to lower prices. We've seen since 2009 a lot of changes just in the landscape of energy in the United States, with very gas-intensive and energy-intensive processes that have been built here to take advantage of cheap energy prices. So the floor for industrial demand, I think, is a lot higher than it was in 2009 during the last major recession. But yeah, I mean, in a vacuum, it could bring some of that domestic demand offline, and that could be bearish or limiting of prices. On the other side of that, you could start to see banks tighten their credit a little bit more, and that can make it harder for producers to continue to operate. So it could be accompanied by a corresponding or even an oversized downturn in domestic production. We'll see. But yeah, it would have an impact on the marketplace. I think the most immediate would be consumption for industrial purposes, and we're seeing most of the data that's pointing at a recession is focused on the manufacturing sector. So that could be certainly a downside risk as we move into 2020, but don't discount the impact that it could have on the production side as well, because those are also companies that are relying on capital in order to operate, and if that capital becomes more scarce, then they might not be able or willing to grow production at a rate that they need to keep the market in balance.
Excellent, thank you. Hey, could you talk further? You talked some about sustainability and the reduction in coal and increase in natural gas. What about cogeneration system? And what are you forecasting or predicting with sustainability goals that some folks say maybe we need to get rid of our cogeneration turbines? And as we all know, those are a lot of them are natural gas powered.
So it is interesting because we talk to universities all across the country, and depending on what region you're in, you're either talking about constructing a new cogeneration facility, or the pressure is to totally get rid of it. And there are still universities that are exploring that as an option to take advantage of cheap gas, and others that are trying to get away from fossil fuels altogether. So we have structured some virtual power purchase agreements that kind of the best of both worlds. You don't necessarily have to maybe take that asset offline and stop just realizing the energy reliability aspect of having your own generation, but realize some renewable attributes from a different project. And it's a different kind of way to be renewable, but it works the same. You're not double dipping. If there's a wind farm in Oklahoma that wants to sell you their renewable attributes, nobody else can use those. So you're essentially offsetting your cogen usage and your fossil fuel emissions at your facility. We also get into selling RINs, renewable energy credits, that come from biogas and landfill gas and things like that that are considered renewable in most markets, and that can have the same impact. You could essentially add some RINs to the gas that you're buying for your cogen plant, and that would offset, at least from an accounting standpoint, the emissions there. So, and then on top of that, I mean, we consult with companies on constructing wind and solar, and companies and universities constructing wind and solar on campus. And that's always an option as well. It's a little bit more capital intensive, but if you're located in the right spot, we can help find the counterparties and at least explore that as an option and see how viable something like that would be for the university. But it's a broad landscape, and we talked to some universities in the South that are just now getting rid of their coal. So it just really depends on the geography and the politics across various parts of the U.S.
Excellent. As we're coming into the last minute, Andy, is there any final thoughts you want to talk about in terms of overall purchase strategies or the market as a whole?
No, I mean, just to reiterate, the opportunity right now for universities especially, I think you're in a sweet spot where you generally have a lot of certainty going forward. We work with some ethanol plants that don't know if they're going to be open in 2 months, but universities are in a unique position where you've got that institutional certainty going forward. And when we look at prices that are so low for so far out into the future, it's just really an unprecedented opportunity to take advantage and to set your university up for budgetary and for overall success out into the forward years, as long as you're using energy. So that's, I think, my main takeaway is that this is a great time to be long-term planning and buying energy.
Well, Andy, we sure appreciate you taking time to share this information. We know at our universities, our utility costs are one of our largest budgets within our facilities. And so having that expertise and knowledge to go ahead and drive down our utility costs is critical, so our universities have additional funds for other items. So, Andy, thank you again. Thank you from all our APA members. We appreciate you taking the time to share your knowledge. And thank everybody, Billy, and the entire folks who dialed in. This broadcast will be recorded and also put onto the APA webinar page within the next 24 hours. Thank you again, Andy. Have a great day. Bye.
Thanks, Chris. Thanks, Billy. And thanks, everybody, for joining.